introductory jokes. Just take my word for it; they're hilarious. And we'll get into the actual meat of the talk, because the way I normally do it is to go through the economy. Because I need to justify those UCSB student loans, which I finally just now got paid off, but also because. But also because this is the thing that really underpins like all the things that play out in our business. And so for me, the good news, or the fun thing, is that the news is relatively more upbeat this year, kind of coinciding with the good weather that we have compared to the rain last year. And most of those major macro indicators are pointing us in the right direction. There's some red flags. I won't beat those to death, but I will just point them out to you, just so that you have those on your radar. Not because we think anything bad's coming down the pike in 2020, but you at least want to know kind of what to keep your eye on. Then I'll get into what everybody cares about, which is what's happening in the housing market. And I can now finally say that over the last couple of months, the effect of these low rates are finally starting to kick in. Right at the kind of introductory phase, as rates were going down, we weren't seeing a lot of traction being gained, but looks like we started to turn the corner and things are moving in the right direction, both on the price front, but more importantly on the transaction front as well. And so overall, we're more optimistic about the housing market, largely because the economy's still in pretty good shape. I will try and beat to death two of my tips for success that I think you need, because there is a lot of uncertainty out there, even though things are moving in the right direction. And I think that the key to circumventing or overcoming some of that consumer confidence issue is not just to sell the home, but to really sell home ownership and get people away from this kind of 2-year view of what their house is going to do or what's going to happen with their home price, and refocus back on those long-term benefits of home ownership, which I think in the wake of 2008, 9, and 10, we've forgotten about the long run of home ownership and are overly focused on what home prices are going to do over the next couple of years. So we need to get consumers in particular away from that type of mentality. But the other thing is just to educate. There's a lot of gap out there in terms of what people think it takes to become a homeowner and what it actually takes primarily when it comes to down payments, right? And so this isn't a particularly FHA-friendly market here in Santa Barbara, but there are still low down payment loan options that a lot of folks don't know about. And I think that, yes, we have an affordability crisis that we need to continue to combat with more supply, et cetera, but over the short run, there's a lot of renters out there making high incomes who could potentially make that jump into home ownership and don't realize it. And so I think if you sell the home ownership and educate a lot on the buy side, that's one of the ways and strategies to kind of navigate a time with kind of uncertain consumer confidence. And then I'll wrap up at the very end with a forecast, but I'll just spoil it a little bit and say that we're less pessimistic than we were at this time last year, again, largely because of those low rates. So things are moving in the right direction, and again, it's mostly because of these economic fundamentals, right? So we just closed out 2019, and we got another 2.1% increase in overall economic growth. Now, that's nothing to write home about, obviously, being with the long run average being about 3%, but it does represent this kind of steady, ongoing pace of growth, albeit somewhat unimpressive, that we've seen for the last couple of years, and we expect that to continue. Now, you can see it's still mostly a consumer-driven show at this particular point in time. Consumers did take a little bit of a step back in the fourth quarter, but overall, consumers are really the kind of component of the economy that's carrying things forward. Now, when times are good and unemployment is low and consumers are spending, that continues to represent a tailwind for us. But I also want to just kind of introduce it as a potential red flag, just because we have kind of all of our economic eggs in one basket at this particular point in time. And so if consumers do decide to take a step back, maybe the coronavirus freaks people out, something happens in the stock market, et cetera, again, we're kind of a one-trick economic pony at this time and don't have a lot to fall back on. Not a huge cause for concern right now, but just something to be thinking about, because again, consumers really are driving the show. Core CPI, I know it says 2.3% here. I'm not worried about inflation that much. In fact, if you look at the fourth quarter productivity growth numbers, it doesn't suggest this huge new surge in wage growth or anything like that. And this is one of those super nerdy, esoteric kind of econ concepts, right? Inflation. But the reason why we care about inflation in this room is because that's what the Fed cares about, right? And so with inflation remaining in check largely, we shouldn't expect a lot of movement one way or the other from the Fed this year, which means that this kind of low rate environment that we're currently enjoying should persist at least through the late stage of this year and probably into 2021 as well. But perhaps the biggest feather in the cap for us right now continues to be the labor markets, right? So we're still at about 50-year lows for unemployment, and we continue to add jobs at a fairly solid clip. We had another 225,000 jobs in January, and so for the most part, the unemployment that we're seeing right now is either structural or kind of like skills mismatch, right? That the jobs are in places where the workers aren't and vice versa, not that there's this kind of big, kind of bucket of folks who really want to work and can't find those jobs. So labor markets are very tight, and that's true here in California as well, right? And so you can see that we had a much deeper downturn than the rest of the United States. We went up to almost 12.5% unemployment compared to just 10%, and yet over the course of the last, I guess it's 10 years now, officially that we're in 2020, we've done a much better job of chipping away at that overhang that was left over from the Great Recession, such that we're pretty much right on top of that national unemployment rate number, even though we were kind of ground zero for the housing crisis back when things started to unwind. On the right-hand side, I'm showing you a million things which you can't read. I'm not trying to get you to digest every single solitary unemployment rate in all these metropolitan areas, but I did want to show you that this is happening all across the state, right? So yes, if you look at the bottom end of this chart, you can see that places like San Francisco and the South Bay, and even Santa Barbara, I think, is in very low levels of unemployment. But this is something that's happening even in our most kind of rural, agricultural-driven economies. So, these top two are, I think, Tulare, Merced, and Bakersfield. And those are markets that were up in the kind of 20 to 25% range for unemployment. And even there, we're down in the single digits. So yes, it's happening in markets like this, where there's lots of tech and tourism, and similarly in the Bay Area, but it's also happening all the way across the state. So moral of the story is that those fundamental economic indicators that tell us people are working, their incomes are rising, right? This whole demand side of the housing equation continues to move in the right direction, and that's true right here in our own backyard as well. Now, this is one of those economic concepts where it's not super nerdy and esoteric. This is really where the rubber meets the road for our business between these macro indicators and our customers' pocketbooks, right? The good news there is that rates, and actually I'm a week behind, I think they've even dropped down a bit lower since then to about 3.5%, but I want to show you that these rates are very low. We're basically right on par with these historic lows for mortgage interest rates. That represents a real tailwind. But also, I like bringing this kind of 50-year history on rates because I get asked all the time, right? When rates went up to 3.6 from 3.5, people freaked out, like, is rates going to go up and this is going to submarine the market, right? And then they go back down to 3.5 and we gain 10 basis points, and now we're supposed to get a new flood of buyers. Well, this zoomed out perspective, I think, is really critical to keep in mind, right? Because even if we jump around, 20 basis points here or there, the environment to borrow money to invest in real estate has really never been better. And I still want to remind you guys about how, my dad used to drag me around to his dinner parties in the 80s, bragging about his 12.5% mortgage interest rate, right? That was like his real bragging rights with all of his buddies. And so I think from that perspective, rates is not the thing that we have to worry about. That's going to continue to, again, be that tailwind, at least on the buy side, and also realistically on the sell side too. To the extent that your sellers are going to turn around and become buyers themselves, it's a good time to lock in those rates and get a move on, right? And this is why it matters so much, right? So if you rewind the clock back about a year, we were basically above 4.5% on that 30-year fixed rate mortgage. At that time, we saw a flood of new listings come on the market, lots of anxiety and uncertainty about whether a recession was going to come down the pike. But as rates really came down, it has a huge impact for our consumers. So on the right-hand side, I'm showing you two things. One is the growth in that median priced home here in California. And as rates really went up, we saw that price growth started to dip into the low single digits, right? We had a lot more listings coming on the market. We had buyers kind of going into a wait and see mode, so there wasn't that much upward pressure on home prices. And the reason why that matters so much is that when you put that together with rates that have fallen by essentially 100 basis points, well, that's what I'm showing you in this light blue line here, is the growth in not the price of that home, but the mortgage payment on that home at current interest rates, right? And so even though, prices were still growing by 2 to 3% or so, when you took that together with lower rates, it actually meant that the mortgage payment on that home was more affordable. It was a lower mortgage payment, even though that home was more expensive. Now you can see that as we've kind of bottomed out at around 3.5%, some of the impacts of that are wearing off, right? So we don't have these steep negatives in terms of mortgage payments continuing to fall, and that's largely because people have decided that the world isn't actually ending. We don't have this huge flood of listings onto the market. Buyers realize that they want to get back into the mix, and that's pushed prices up at actually the fastest pace in about 6.5 years. And so, we've kind of bottomed out on those rates, but they're definitely helping to, get our buyers in a position where they can be a little bit more competitive with their offers, which I think is key. So how is that all playing out in the housing market? Well, I have good news and bad news. The good news is that sales have started to go up, right? We had a 7.5% increase essentially at the end of 2019, and we'll be putting out our numbers for January in about a week, but those show that things continue to move in the right direction. Now, the reason why I'm not just kind of wholesale shipping that as positive news is because when you do take a step back and zoom out and look at the overall trend, a lot of this economic growth that we've seen over the course of the last 10 years hasn't materialized into like gangbusters new transactions, right? Yes, this kind of dark blue area, which represents 2019, we did see those numbers start to creep up at the end of the year, but you really kind of have to squint at this chart to pick out which years were growth years since the recession ended and which ones weren't. We've essentially been bouncing around at about 420,000 home sales for the better part of the last decade, despite the fact that we've gone from 12.5% unemployment down to 3.5% unemployment, or that we've added, a couple of million more new jobs. Usually that used to mean lots more home sales, and I think this is why we could be more optimistic, but we don't want to go home and pop those champagne corks or throw our business in cruise control, because there's still these kind of structural impediments that will prevent all these tailwinds, which we are currently enjoying, from turning this into a blockbuster year. So things are moving in the right direction, but it's still very much a hustle game and a kind of elbow grease type of environment out there in the housing market. It is trending in the right direction, right? You can see in this one just how much rates play a role, right? Because when rates were close to 5%, we saw sales declining by double digits. As rates started to come back down, those declines got smaller and smaller and smaller until as we entered the fall, we started to see transactions actually start to creep back up. So this is a trend that's been happening over the course of the last 5 or 6 months for sure, but it's actually something that started pretty much at the end of the first quarter of 2019 as those rates started to creep back down. So the other reason why we don't want to get too optimistic is because we're starting to see some of these familiar themes that we saw back in 2016 and 2017 rear their ugly head again, particularly on the supply side, and that's causing the bottom end of the market. And I know this is a laughable bottom end of the market for Santa Barbara County, but there are markets that have under 300 in some parts of California. But the point being is that the top end of the market is really where we're seeing most of the growth, and that should be an encouragement for the folks sitting in this room. But for those first-time home buyers, they're going to continue to be up against it as these listings really start to dry up in the wake of this kind of otherwise positive news, that people are more confident, they feel like they can camp out on that house again and not have to just dump their listing and get ahead of the curve, right? So, and you can see that the top end really was driving the show after being negative for many, many months consecutively. As we got into November and December, we really saw that the gains in the stock market and also just that kind of regaining of some of that consumer confidence about the future trajectory of the economy has materialized into the top end of the market actually being the fastest growing segment. So that's a good thing for the folks in this room for sure, but it's just a pretty nice bellwether for the direction that things are heading, because these are, again, especially at the top end of the market, highly influenced by psychology, right? On the listing side, that's where the news isn't as good, right? So again, if you go back to when we were at 5% rates, essentially, we saw a flood of new listings onto the market. Listings were actually growing by 35% as people thought that the housing market was about to tank, that prices were about to fall. But as rates started to come back down, you'll notice that the gap between what was on the market in 2019 and 2018 started to really shrink back up, such that by the time we got through the summer and into July, listings were actually falling again, right? And that started to really accelerate as we got towards the end of the year. And I think that this number down here in December was like the lowest level, the lowest number of actual active listings on all of the statewide MLSs that we've seen in like 7 or 8 years. So listings will be a problem. That's one of the reasons why, even though we're more optimistic and we are projecting growth, that growth isn't like double-digit growth, right? Because there's just gonna not be enough units to go around. And you can see that here, right? So big correlation between those jumps in rates. People were freaked out. That's what I call the kind of brother-in-law effect, right? Where people are like, the market's about to tank, and people really wanted to get ahead of that curve. As we realized that wasn't the case, homeowners in particular went right back into that kind of don't want to move, camp out, and let's accumulate that equity kind of mode. And that's what you're seeing play out here, and why it's going to be harder to grow transactions by more than a couple of percentage points, even with kind of overall good economic data. And that's going to be particularly true at the bottom end of the market, right? So if you look at active listings under $1 million, right? Severe contraction. We're going right back the opposite direction from where we were when rates were at 5%. So ultimately, if things aren't for sale, then they can't be bought, and that's going to impede much more robust growth in closed transactions, right? You see that in the market competition statistics, right? This is kind of heartening for me for paying all those student loans, because you see that, yes, the laws of supply and demand are still working out there, right? When we have lots of new demand from a good economy and low unemployment, low rates, et cetera, and not enough housing to go around, well, that means that the market gets a lot more competitive. And lo and behold, that's what we see is the median time on market, this is from list to pending, has been actually dropping for the first time in about 18 months. So we're still, below a month in terms of that median time to sell. And that's moving in the right direction. We're also not seeing a lot of discounting to speak of, right? So, whenever I go out and do these talks, that I show this great economic data and that the economy continues to move forward, and you always get that comment like, yeah, but my brother just told me that the prices are about to tank and that everyone's cut price. That doesn't seem to be backed up by the actual data. The median sales to list price is about 98%, and that's actually up about 100 basis points from where it was at this time last year. So homes are selling more quickly, and there's actually fewer sellers discounting out there, and that's a testament to this lack of available supply and the good demand of folks who want to take advantage of these low rates while they've got this good job and their income is growing. And so for me, this really flies in the face of this kind of notion that prices are on the precipice of a major cliff here in California. And indeed, if you look at, that's closed sales, right? So we were looking at closed sale prices relative to that list price previous. This is looking at just actives, right? So we just asked the simple question of all the actives that are still active on the MLS, how many have actually had a price reduction? It's still about 35-ish%. But what's really interesting is that if you turn this into a kind of year-over-year growth number, what you can see is that percentage has been falling for the last 5 months in a row. And so there is no evidence that more and more sellers are cutting price in general, right? In certain segments, in certain areas, absolutely. But on par, we're seeing fewer active listings actually have to cut price. And again, this is just a testament to supply and demand. There's lots of people who want these homes and not enough of them to go around. Sellers aren't in a position where they're really being forced to dramatically cut prices. And lo and behold, we see those prices actually stabilizing. So we did see some weakness in prices, particularly in the Bay Area. Prices were actually down during the kind of first half of 2019. But again, as demand started to perk back up, what we saw is that prices actually started to stabilize. In fact, in December, we had the fastest pace of growth in about 6 years. Home prices were up about 10% on a year-over-year basis. What's really interesting is actually that's the second highest price of the year. usually December is a fairly slow month for home prices, right? We usually have our peak price somewhere in like June or July, and the fact that all these buyers in particular started to come into the market as the listings dropped off, that's really led to this precipitous increase in home prices. In fact, I think we busted through our all-time high home price last year of about $617,000 was that overall peak price. And actually prices are growing across the board, and what's really interesting is that you see prices going up at the top end of the market. So I've divided the market up into percentiles. That orange one represents the top 20% of homes in California, and you can see that from about late 2018 onward into about the third quarter, prices at the top end of the market were actually coming down. But, again, as people's confidence and the uncertainty started to fade, we saw that, top end started to follow suit with the rest of the market where that demand had come back and prices are actually growing again in every single market segment in California. Again, that's a positive. And probably this is the one that I would print out for those brother-in-laws at that backyard barbecue who are like, trying to infect all of your buyers about the market being about to tank. This is something that I did where I just turned the housing market into a straight up retail model. We looked at how many homes got sold, and then we looked at how many new listings, not how many total listings, how many new listings did we put back onto the MLS to replenish those sales. And so that's this blue line here, which I've called market velocity. That's what happens when you let the data nerd name the economic indicator. But when it's going up, it basically tells us that there was a lot of sales and not a lot of new listings coming back onto the market. And when you overlay this on these green bars, which represent the growth in the median priced home, you can see that really supply and demand do drive the show from the housing market standpoint. It does a phenomenal job of predicting these peaks and valleys in terms of where closed sale prices are going. Well, look where it is today, right? As we have this kind of 6.5-year best increase in transactions and a 30% reduction in the number of active listings out there, market velocity went up, and we had our fastest growth in home prices in a long time, right? So this really is down to the fundamentals. People can pick out all these crazy stories that they see on the news as reasons why things are going to tank, but when you really take a step back and look at the fundamentals, the demand is there and the supply is not, and that means that at least from a price standpoint, things should continue to move forward, right? So overall, the news is relatively good. The economy is doing well. Rates are low. Buyers do seem to want to take advantage of this and try and jump back into the market. So for all intents and purposes, I could just leave it there, right? But I want to just be a wet blanket for a second and tell you not to throw it in cruise control and just expect that the market with all these tailwinds is going to dump all these new sales and listings into your lap. Again, we do have a consumer confidence issue, and that's what I'm showing you here, that only 1 out of 4 Californians are thinking that it's a good time to buy. So regardless of all the great economic data, we're going to have to come up with those responses to folks who are saying, well, my brother told me to wait, right? Or aren't prices about to go down? Or what happens if there's a recession? You're going to want to be armed with the information to kind of combat that. Elsewhere, down payments are still high, right? So even though rates are low, you still got to come up with a boatload of money to get your foot on the property ladder. That's going to continue to be an impediment as well. And even though low rates have actually meant that the mortgage payment on that median priced home is slipping, it's still relatively high, right? So yes, at the margins, this is going to help folks who are either priced out or couldn't be as competitive as they wanted on the buy side, but it's not going to be a sea change in terms of totally changing the game on the demand side of the equation. And of course, at 2.5 months of supply, inventory is going to be that kind of predominant factor that prevents us from kind of turning all this great economic trends into a really gangbusters year on the transaction side. And of course, nobody can still afford it. If you want to talk about this housing affordability index, we can, but it's basically about 70% of folks cannot afford the typical home, and that's going to keep folks from jumping into the market. And that's without even talking about all the other sources of economic uncertainty. I'm going to hang out after this. I won't beat you to death and bore you to death with these, but if you want to nerd out on these other sources of economic uncertainty, I'm happy to do that with you after the fact. And so again, for me, it's not just about selling that home, it's about selling the home ownership and getting the buyers focused on what home ownership is really all about, the long-term wealth creation, the educational benefits for your kids, the health benefits for you and your family, the societal benefits, which they may or may not care about, but there's a lot of even just kind of self-serving reasons for you to want to be a buyer and to be focused not on the next 2 years, but on the next 10 years, because if we look at the price numbers, right, we've basically more than doubled where we were just over the last 10 years, and imagine where that line is going to look like 20 years from now. That's where we need to get our buyers focused, and if we can do that and educate them on what it actually takes to get into a housing market, I think that's how we navigate this kind of period of where the kind of Kool-Aid effect or brother-in-law effect is still alive and well. So that's a wrap for where we see the overall market going. I have my forecast, which I'll save till the end, but I'll also just kind of sum up by saying that yes, low rates are pushing the market forward and prices are responding to this kind of excess demand, and as a result, the market is more competitive, right? There's still going to be a lot of challenges, namely on the supply side, which is going to mean that affordability will probably deteriorate, and that folks are going to continue to wonder, is it a good time to buy? Is it a good time to sell? So make sure you've got your responses ready on those. But overall, we're less pessimistic, so if you don't just sell that home, but sell the home ownership, then you will be good to go. So thank you guys so much for having me back, and look forward to chatting.